There is a very specific moment in every major bull market where the crowd piles into the obvious names, bids them up to the point where the math stops working, and then completely ignores the companies doing the actual heavy lifting underneath. We are living in that moment right now. The AI trade has become so crowded, so loud, so fixated on a short list of household names that a large number of genuinely exceptional businesses are being completely overlooked. And I want to be clear about something before we get into today's picks. These are not lottery tickets. These are not early-stage companies asking you to believe in a story that has not played out yet. The two stocks we are going to break down today have real revenue, real margins, real earnings, and in both cases, real visibility into future demand that extends years out. If you have been frustrated watching the market chase the same 5 names while your portfolio sits still, this video was made for you. We are going to take our time and give you the full picture on both of these. Before we get into it, if you are new here at Ticker Hawk, we cover stocks with real substance behind them, not hype cycles, not social media momentum. If that is the kind of research you want showing up in your feed, go ahead and hit subscribe right now and turn on the bell notification so you never miss a breakdown. We put a lot of work into every video, and the people who find value in it are exactly the kind of investors we built this channel for. Now let us get into it. The first stock we are talking about today is Broadcom, ticker AVGO. And I want to start by asking you a simple question. When you think about the companies that are powering the AI revolution at the infrastructure level, what names come to mind? Most people say NVIDIA, some say AMD, a few will mention TSMC. Very rarely does the average retail investor mention Broadcom. And that gap in recognition is exactly why this opportunity exists right now. Because if you look at what Broadcom is actually doing inside the AI economy, the numbers are staggering. In their second fiscal quarter of 2026, Broadcom posted record revenue of $22.2 billion. That is a 48% increase year over year. Now, on its own, that is a remarkable growth number for a company of this size. But here is where it gets really interesting. The AI semiconductor segment specifically came in at $10.8 billion for that single quarter. That is a 143% increase year over year. Not 43%, 143%. In that single segment, AI semiconductors alone now represents nearly half of Broadcom's total quarterly revenue. Let that sink in for a moment. For the full fiscal year, Broadcom has guided for $56 billion in AI semiconductor revenue. That would be an increase of 180% compared to fiscal 2025. And they have already put a target on the table for over $100 billion in AI semiconductor revenue in fiscal year 2027. These are not aspirational figures being floated to excite investors. These are numbers backed by long-term supply agreements with some of the biggest names in technology: Google, Anthropic, OpenAI, Meta, order visibility that stretches all the way to 2028. When your customers are signing contracts that lock in demand years into the future, that tells you something very important about how essential your product actually is to their long-term roadmap. And then there is the financial quality of this business, which deserves just as much attention as the growth numbers. Broadcom generated $10.3 billion in free cash flow in a single quarter. That is a free cash flow margin of 46% on revenue. Their EBITDA margins came in at 69%. Let me put that in perspective. 69% EBITDA margins from a company that is primarily known as a hardware business. Those are numbers you typically see from elite software companies, not semiconductor firms. The reason Broadcom can operate this way comes down to how the business model is actually structured. And it is genuinely one of the most elegant setups in the entire technology sector. Broadcom does not own chip fabrication plants. They do not take on the capital-intensive risk of building and running semiconductor fabs. Instead, they own the intellectual property, the chip architecture, the design expertise, the proprietary packaging knowledge, and they license that capability to the biggest technology companies in the world. Here is how it works in practice. A company like Google needs a custom AI accelerator chip built to its own specific architecture. The challenge is that designing and packaging a chip at that level of complexity requires deep semiconductor expertise that even a company as large as Google does not fully have in-house. So they come to Broadcom. Broadcom uses their catalog of proprietary IP to design and engineer the chip, then passes the manufacturing works to foundries like TSMC. Broadcom collects an engineering fee on every single unit shipped. They carry zero manufacturing risk. Their capital expenditure requirements are minimal, and the margin they capture on that model is extraordinary. That is the custom silicon engine. But Broadcom has a second revenue driver that is arguably just as important and significantly less visible to the average investor. When you're building a large-scale AI compute cluster, you're connecting tens of thousands of processors together. The connections between those processors, the high-speed data lanes that move information across the cluster, become one of the most critical bottlenecks in the entire system. Broadcom's Tomahawk switching chips control those data lanes. You cannot build a high-performance AI cluster at any meaningful scale without them. This is the kind of product that gets almost no press coverage, but it is deeply embedded into the infrastructure that every major AI company is building right now. And then there's a third engine running simultaneously on top of both of those. The VMware enterprise software business generates predictable recurring subscription revenue from deeply embedded corporate clients who have built their entire IT infrastructure around that platform. Switching costs are high, churn is low, revenue is sticky. So what you have with Broadcom is three completely different revenue streams: custom AI chip design, AI networking hardware, and enterprise software subscriptions, all operating at the same time and reinforcing each other. Now let us be honest about the risks, because no stock breakdown worth your time is complete without a real look at what could go wrong. The biggest concern with Broadcom is customer concentration. Google has historically been the single largest customer for the custom chip division, and there is a legitimate question about whether hyperscalers like Google could eventually develop enough in-house chip design capability to reduce their reliance on Broadcom over time. It is a reasonable concern, and it is one that serious investors should think through. The honest answer is that it is a real risk, but a slow-moving one. Replicating Broadcom's proprietary IP catalog and deep engineering expertise takes years of sustained investment, and it comes with serious patent exposure risk along the way. Most technology companies look at that math and decide it makes far more sense to continue paying Broadcom rather than wage an expensive multi-year legal and engineering battle to recreate what Broadcom has already built. And crucially, Broadcom's customer base is diversifying. Every new frontier AI lab that reaches meaningful scale eventually needs exactly what Broadcom offers. The more the AI ecosystem grows and matures, the more demand consolidates around Broadcom's core capabilities. The combination of the custom silicon business, the networking footprint, and the software recurring revenue creates a business that is genuinely difficult to disrupt, especially because its most important customers depend on all three layers simultaneously. This growth story has been built over decades, and that is not something a competitor builds overnight. Drop a comment below right now and let us know what you think about Broadcom, whether you already own it or whether you are watching it. We read every comment, and it shapes what we cover next. The second stock on our list today is one that takes artificial intelligence completely out of the data center and puts it to work in the physical world. The company is Symbotic, ticker SWIM. And the reason I want to spend real time on this one is because the market has been significantly mispricing what this business actually is and what it is building toward. Symbotic goes into traditional distribution centers and warehouses and essentially rebuilds them from the inside out. They construct a dense, multi-level steel grid structure inside the existing facility. They then deploy a fleet of autonomous robots, each one running on computer vision and machine learning software to move through that structure at high speed, sorting, stacking, and retrieving inventory with minimal human involvement. The robots are fast, precise, and they operate continuously around the clock in a way that human workforces simply cannot replicate. For large-scale retailers and distributors dealing with the relentless pressure of rising labor costs, throughput bottlenecks, and inventory accuracy problems, this system represents a fundamental transformation in how their operations run. The business model has two distinct phases. Phase one is the installation and system build-out. A customer signs a multi-year, multi-million-dollar contract in Symbotic engineers and deploys the physical infrastructure inside their warehouse. That generates significant revenue up front. But phase two is where the real long-term value lives. Once the system is installed and operational, there is an ongoing software subscription layer, maintenance agreements, system upgrades, and continuous optimization services that run on top of everything. That is the recurring revenue engine. That is where the margin profile of this business compounds over time, with every new deployment that comes online. Right now, Symbotic is sitting on a contracted backlog of approximately $23 billion. That is not speculative revenue. That is signed contracts from customers who have already committed. The question is not whether that revenue arrives. The question is the pace at which it gets recognized, and we will come back to that. Here's what the market seems to be getting wrong about Symbotic. Wall Street has largely been pricing this company like a hardware assembler, like a business that builds things, ships them, collects a one-time payment, and then moves on to the next job. But the hardware is really just the entry point into a much longer and more valuable relationship. The long-term value of every Symbotic deployment is the software layer that sits on top of it, and that software layer compounds as the customer base grows. And as the company refines and improves the platform with each new installation. The hardware gets you in the door. The software is what makes the business model truly exceptional over a multi-year time horizon. And Symbotic has now reached GAAP profitability. That is meaningful. It validates that the fundamental unit economics of this business actually work. On top of that, Symbotic carries minimal debt and holds over $2 billion in cash on the balance sheet. That is a significant cushion. It gives management the ability to be patient, to invest in expanding deployment capacity without being pressured by short-term financial constraints. Now the risks here are real. They deserve a straightforward conversation. The most visible one is installation complexity. These are not simple systems to put in place. Each deployment involves months of structural engineering work, software calibration, and on-site configuration. If a customer delays the start of their rollout for any reason, or if Symbotic encounters unexpected complications at a given site, the revenue recognition on that contract gets pushed into future quarters. This dynamic has created volatility in Symbotic's quarterly results, and it has contributed to some of the weakness the stock has experienced recently. It is a genuine execution risk. The second risk is customer concentration around Walmart, which has been the anchor client and the most significant relationship in Symbotic's entire growth story to this point. If Walmart were to meaningfully slow down their deployment schedule, it would have a real impact on near-term revenue. But here's the broader context that matters when you think about those risks properly. The installation process is becoming faster and more repeatable as Symbotic accumulates experience across more deployments. And the Walmart relationship, rather than being purely a source of concentration risk, has also functioned as the most powerful, real-world proof of concept in the entire warehouse automation industry. When one of the largest and most operationally sophisticated retailers on the planet deploys your system at scale and continues expanding the relationship, it sends a very clear signal to every other major retailer and distributor that is watching. Companies like Associated Wholesale Grocers are rolling out Symbotic systems across multiple sites. Other large retailers are evaluating the proposition and moving toward commitments. The $23 billion contracted backlog, the clean balance sheet. With over $2 billion in cash, the demonstrated path to GAAP profitability, and a customer pipeline that is actively expanding, all point to a business executing on a large and durable long-term opportunity. The market is pricing in the risks, but in our view, it is not fully pricing in the quality of the recurring revenue model or the durability of the demand that is already contracted. If you have stayed with us through this full breakdown, that tells us something. It tells us you are the kind of investor who wants to understand what a company actually does before making decisions. If you found value in this video, please hit the like button before you leave. It makes a real difference in how many people this content reaches. And subscribe if you have not already, because this is what we do here every single time, to bring everything back to where we started. The market right now is doing what markets do in periods of high sentiment. It is rewarding noise and ignoring substance. Broadcom is one of the most strategically essential companies in the AI infrastructure stack, generating free cash flow at a pace and margin that most investors would find hard to believe before they looked at the actual numbers. Symbotic is taking artificial intelligence out of the server room and deploying it inside the physical economy in a way that is creating real, compounding, recurring value with every single warehouse that comes online. Neither of these is a speculative bet on a future that might not arrive. Both of them have the financial foundation and the contracted demand visibility to continue executing through short-term volatility and deliver on a growth trajectory that extends years into the future. Do your own research. Understand the risks we walked through. Size your positions in a way that matches your personal situation and your risk tolerance. But if you have been looking for a breakdown of two businesses that are genuinely building something real and durable in this market, you just watched it, we will see you in the next one.